Is this a crash or a correction? That is the question. We're going to talk about that on today's Stock Market Brief show. If you just take a look at where we pulled back with the SPY on the daily time frame, we've only pulled back 5.15% on the SPY, and the Qs it's 7.68%. On the semiconductors was pulling back 10%, which is considered a correction. IWM is 7.6% pullback. 3 candles in a row closing basically at the lows of day. You can see that authority of these candles gaining some momentum. You can see a smaller body to a bigger body to even a bigger body, all closing at the lows. So some powerhouse selling in recent trading days. A Dow Jones Industrial Average, DIA, is only down 3.3%. So when I think about crash versus correction, no, I don't believe this is a crash by any means. However, when you pay attention to something like the bond market is moving. The 10-year yield has been ripping higher, sending the TLT and other various bond products down, which does seem more like a crash. You can see we're up here right at around, just even looking back just less than a month ago or about a month ago, 101.50, and now we're trading down here around 93. You do see a small positive divergence forming there in the RSI with a little bit of a hammer candle. Begs to ask the question, are 10-year yields, as we're coming into this prior area of recently resistance, is this resistance going to hold up where yields are going to take a little bit of a break here? Because we do know that 10-year yields and the dollar on this strong move has been putting pressure on equities and various commodities as well. If you take a look at how the day performed today, the 11 sectors were almost down in the red again. Energy is the one that snuck into the green, but all the index products here are in the red. NASDAQ 100 was the one that got hit one of the hardest, along with the NASDAQ Composite and mid-cap stocks. That secret level that we've been talking about over here has finally been absorbed. They did move it up to 44.10. It was at 44.05. You can see price, once it got and absorbed that liquidity, supply ran through, and we still kind of pressed through a little bit further to the downside. If we continue on and look at oil, oil was actually up on the day, so this has been coming off a little bit, and we saw a little bit of a bounce, a gap down, finished green on the day, which is typically more of a bullish sign, but we'll see here if it needs a little bit more time to consolidate that recent run-up. Copper also, surprisingly enough, had a pretty bullish-looking candle, how it gapped down, engulfed the entire body. It was an outside trading day, and we know that from the past data, copper has been a leading indicator to the S&P 500, where, the S&P 500 was selling off over here, making an October low right around this area, while copper was actually putting in higher lows in that area, giving us insight to say, hey, maybe we potentially might see a bounce higher. Well, we saw the same thing over here with copper putting in a higher low, but it goes in reverse too, where copper puts in lower highs, right, while the S&P 500 is putting in higher highs. It tells us that, hey, we got to just be careful up in these areas. And while copper sold off along with the S&P 500, but now we're starting to see that potentially turn here. Also to note, silver was actually up on the day, almost up 1%. The silver chart is actually the red and green candles. The black candles is the GDX. The GDX, as you can see, tracks silver pretty good. So if you're looking for, a bounce in silver, you might be wanting to pay attention to the miners as well. If we continue on, gold was down slightly on the day. That would most likely because of the 10-year yield alongside the dollar continues to press higher. So as soon as those things back off, I think that this thing will see some strength, some relief as this thing's been kind of flushing. We've had multiple days at the downside. So 1, 2, 3, 4, 5, that was down, 6, 7, 8, 9 days or so in a row to the downside. So pretty aggressive selling in gold. Bitcoin after hours today took a big $2,000 hit in the matter of minutes. I'm showing you the Saylor to Schiff tool right now. It is still on a sell signal. So we had this buy signal, crossed up through here. I think the trigger was right over here. And then it basically whipsawed us right to a sell signal. But as you can see, as we still remain in that sell signal territory, it at least avoided this fall. And this signal has been working, very well throughout the course of, since we've been able to track Bitcoin with it. If you don't know about this, you can just look up Saylor to Schiff tool, figuring out money. I have a video on this specific indicator, how you can use it. Take a look at breadth. So breadth in the market, this is percent of stocks above the 200-day moving average, but we're looking at like the NASDAQ, the NYSE, the NDX, the Dow Jones, S&P 100, 1500, mid cap, small caps, and the S&P 500. If you notice this, well, the S&P 1500 is mid cap, small cap, and the S&P 500. As you can see, there's 400 there, 600, 500. You add that together, that's 1500. Okay. And what you'll notice here is I'm just showing the percent of stocks above the 20-period moving average, and you'll see that each of these index products are moving into some pretty bad breath territory over here. Needs a stick of gum to clean that up. But the S&P 500 will pay attention to because that's at 14%. So that basically means that only 14% of the stocks in the entire, S&P 500 are above their 20-day moving average. And as we've seen prior, it doesn't last there all for too long. And if I show you this more specifically, I'll bring in the SPX with the percent of stocks above the 200-day moving average. But what you'll notice is this is kind of where it gets into this oversold condition where we can see, potential moves in periods of time to move up right here, right? Backs up. Right here too, boom, started moving up. Here, it started moving up. Well, we're not quite there to very overextended, but we are moving into that direction. This was marked at the 10 for oversold condition, and we've seen times where it even gets even deeper below that, where the entire S&P 500 is almost all stocks are below their 20-day moving average. But just wanted to call that out, that breadth is worsening, but it's getting to a point where we could very well see a bounce in the near future. And you could pair this with many other charts like the bullish percent index. We'll take a look at the RSIs, how they're all moving into this oversold condition. This is the NASDAQ composite doing that. We have the BP NDX. That's still moving into oversold condition. And we talk about these when they get overbought and oversold. And these levels, they can hold for a while, but we got to get in front of it and just let us know where it currently is on these signal charts. So the NASDAQ 100 there in oversold condition. The NYSE is in oversold condition. We have the BPOEX, which is the S&P 100 now moving into oversold condition. We've got the BP SPX in oversold conditions getting cracked through that 70 level, but still the level remains relatively high. It means 58% of the stocks in the S&P 500 are on buy signals based off point and figure charts. The discretionary sector is moving that oversold condition to a level that we haven't seen really since mid-March there. The healthcare sector moving into that oversold condition. We have the industrial sector moving into oversold condition. We have technology sector. This one's getting pretty smoked to the downside. So now this is around 35, which is right around where this was. But you can clearly see the RSI is in more oversold condition. We were talking about this negative divergence for quite some time, and there you go. There it played out to the downside. Whereas we can very well see something like this happen where we get a positive divergence like that. That's always a possibility. And then potentially that might lend a hand to a better bounce. Real estate sector, oversold condition. And then we also have staples in oversold condition there too as well. If we take a look at how the day performed on the S&P 500, we came down to the daily expected move. Remember, 68% of the time it closes within there. It closed basically on it, slightly outside of it. 95% of the time within the 2 sigma levels. We definitely closed within inside that. You can see the day started here. The daily VWAP held as resistance. We tried to get back above it, so that could have been a potential good move to the upside, but it then got faded. So you want to watch out when we're above a declining daily VWAP. We'll give you the updated levels, but if you remember on yesterday's video, we talked very specifically of what to watch for if we start cracking under the lower weekly expected move. And I posted this on Twitter just to reiterate that, but if you were paying attention to last night's brief, one thing we mentioned was to pay attention to bigger volume when it gets out because things can get very squirrely. Understand that this is outside of what the market anticipated as risk. So what happens? What do dealers have to do? Well, dynamic hedging takes place, and you could see as we're pushing off, we get pops of big red volume, and that's when things could get squirrely. But that wasn't even the end of it right there. That was at 437.54. Well, we followed up on that post where we closed down at 436 down here, and you could see those pockets of volume as we broke down. Guess what? Well, towards more the end of the day here, obviously volume picks up, but we saw a lot of volume crack us to go to that daily expected move, okay? If we take a look at the SPY on the daily time frame, we already know that we're down around 5%. We talked about that bearish engulfing candle, but now I just want you to pay attention to a couple of levels. We also actually talked about that negative divergence that was forming too as well, that we had to be aware of, right? Price goes higher, internals are showing that it's weakening, then you get a weakening candle, gives you some insight, then we had that pop up and everyone celebrated, oh, it's going to mean nothing, and then all of a sudden it meant something, right? Well, there's a couple levels on here I want you to pay attention to. One is last quarter, and then obviously the year to date. So the last quarter is right around that 430 marker. So if price wants to come down, that's the average, the volume average, the anchored VWAP, the average volume weighted price, volume weighted average price, average volume weighted average price. Say that 10 times fast. Price could potentially use that as a level of potential support, and then we have the year to date there too. To this quarter to date, right, we said if it gets below it, be more bearish. Once it gets back above it, be more bullish. Well, you can see we kind of doodled around and we got cracked. Now, if I anchor a VWAP to the bearish engulfing candle or the outside trading candle right there, you can see that that's kind of in line with the quarter to date. So really, to be a lot more bullish, you'd want to see price eventually recoup that level. If we do that, and this starts turning back up again at some point, even if it comes down and price is just doing this, right? At some point, if price can break through it, that could be a very positive sign for the market, which that would tell us that the average buyer from this high is now in the green, which would be a potential good change in overall market sentiment. Excuse me. If we update the 15-minute chart now, the same thing remains. We're below a declining 5-day moving average, so bearish, right? We talked about that. What you want to see is it start flattening out and going back up. I said you can try to be tactical and play little bounces, or you can just wait it out, right? Because if you try to play a tactical bounce, or you try to buy the dip, well, I mean, this is what can happen. You can get smashed. So continue to just be patient here, wait for that to turn up. If you are playing tactically, let's look at the key levels. So we have the 2 sigma level here at 429.33, the lower daily at 432. If you want more direct, you can come to my Twitter. I'll update you on these so you can just blow them up and look at the charts. As it stands, right, we're cracked below the weekly. 68% of the time it closes within it. So if we don't get any big news event, right, we have one more trading day left. What happens to be a Friday where, it's known as VIX Crush Friday. So if we do start coming up, start looking into this area right here where price might feel comfortable at, right? There's plenty of times where price just doodles around the lower weekly expected move once it tags it. The cues actually that what we discussed yesterday too was selling's going to have to occur in the big tech names in order to really bring this down, and the cues landed on their lower weekly expected move. So if we do start seeing a bounce there, it could probably bring it right up into this area. If we start seeing even more strength from the upside, pay attention to the 2 sigma level at 443.25. That would be above technically the week to date anchored VWAP, which is declining, and the 5-day. So as it stands right now, it's just a time to be, just be patient, be cautionary from the long side. If you are playing long bounces, just be tactical. And if you're shorting, you don't really want to short the lows. You want to wait for bounces, and then when it gets back below the daily VWAP, where you can see intraday smaller lower highs and lower lows, and then you can play cracks down to the downside. That's all I got for you on today's episode, everybody. See you later.